In less than 2 months, the S&P 500 dropped over 20%. Not a stock. Not a sector. The entire market, the largest, most watched index in the world, just fell off a cliff. At its February peak, the S&P touched 6,147. By April 7, it was scraping a 52-week low at 4,835. That is one of the sharpest market drops in recent history. And here's what makes it worse, it wasn't just the index. The tech-heavy Mag 7 ETF? Down nearly 30% during that stretch. This isn't fear-mongering. It's reality. And it has investors asking, what next? Trade tensions. Global instability. A growing, sell America, trade. Shipping from China to the US is plummeting, expected to fall nearly 40% next month, per the Port of LA. Markets may have bounced slightly, but the damage is real. And recovery won't be quick. So how do we adapt? Today, I'm going to walk you through 5 stocks, and 1 ETF, that could bring stability to your portfolio during these uncertain times. But before we dive in, please hit that like button, subscribe, and help push this video to other retail investors who need perspective right now. Hey everyone, Ernest here, CA and MBA, not a financial advisor. This is not financial advice. Now, let's get into it. Stock number 1. Berkshire Hathaway. Ticker: BRK, B. This isn't just a stock, it's an ecosystem. Private businesses, equity holdings, and over $300 billion in cash. Buffett's been criticized for sitting on that cash. But in this downturn, it's looking more like wisdom than caution. Market cap: $1.1 trillion. 12-month return: plus 30%. Year to date: plus 15%. Outperforming the S&P significantly. Berkshire is defensive, diversified, and loaded with optionality. Valuation? Not cheap. But I'm targeting a buy near the 100-day moving average, around $500 per share. Stock number 2. Procter & Gamble. Ticker: PG. In a downturn, people don't buy new TVs. They buy toothpaste. PG is a defensive consumer staple with decades of dividend growth. Market cap: $380 billion. Dividend yield: 2.6%. 5-year dividend growth: 6%. Shares have been flat. That's fine. Stability is the name of the game here. Valuation? Forward PE of 22.8. EV/EBITDA at 16.5, below 5-year averages. Buy zone for me? Around $155 per share, where it's shown strong support. Stock number 3. SOFIE Technologies. Ticker: SOFIE. This is my higher risk play. It benefits from deregulation and appeals to high-income, tech-savvy young adults. Market cap: $15 billion. 12-month return: plus 60%. Year to date: 15%. Revenue growth projected at 20% per year. EPS next year estimated at 50 cents, giving it a forward PE of 25. I'm not buying outright. I'm targeting a $9-10 cash secured put. Volatile stock, so play it smart. Stock number 4. Alibaba Group. Ticker: BABA. Yes, it's Chinese. And yes, I usually avoid that. But right now, China is bouncing back, and Alibaba's diversified model stands to benefit. Market cap: $283 billion. 12-month return: plus 55%. Year to date: plus 40%. Next year's EPS: $10.15. Forward PE: 11.8. PEG ratio: under 1. Strong numbers. Like SOFIE, I'm not buying shares yet. I'm targeting a $95 cash secured put. JP Morgan Equity Premium Income, JEPI, and stock number 5. Isn't a stock. It's an ETF, JP Morgan Equity Premium Income. This ETF combines S&P exposure with options income. It sells out of the money calls and distributes profits monthly. Yield right now? Over 8%. Assets under management, $38 billion. Expense ratio, just 0.35%. Down 2% over the past year, but that doesn't include the hefty distributions. JEPI shines in sideways or down markets. This is my parking lot for cash in shaky times. Not a forever hold, but a smart defensive play. There you have it. 5 positions to consider this May. Berkshire Hathaway. Diversified defense Procter & Gamble. Stability and dividends Sophie. High beta growth with smart entry Alibaba. Risk-adjusted rebound JEPI. High yield income buffer. Down in the comments, let me know which of these 5 you're most interested in, and how you're positioning your portfolio this May. And hey, if this helped, hit that like, subscribe, and share it with a friend who needs smart investing ideas right now. Thanks for watching. Stay calm, stay informed, and I'll see you in the next one.